Hi, everybody, and welcome back to video number 3 in chapter 15. And when we left off, we sort of got truncated off a little prematurely. We were looking at this Charlie situation here, where we're assuming now that instead of convertible bonds, Klinger issued 2 million bonds without the conversion feature on April 1 at 102. Each $1,000 face value was issued with one detachable stock warrant in review. Shortly after the issuance, the bonds were selling at 98, and the warrants had a fair value of 30. So we got into that a little bit when we left off, and we were looking here at how we came up with this $60,594. Here we had the cash of $2,040,000, and the discount on bonds payable was $20,594. And we got this $1,979 by this arithmetic here. And here we took the fair value of the warrants and the relative fair value of the warrants, and then the proceeds. And we multiply that through, and we do the same thing with the warrants. Here the fair value for the warrants was $60,000. That was $2,000 times $30. And then the relative fair value was the $60,000 times, which we calculated here, divided by the 2,020,000 multiplied by the 2,040,000, and that gave us 60,594. And so the fair value of 2,020,000, now we are able to allocate that up to 2,040,000. So that difference of 60,594 we're showing here in paid-in capital for stock warrants. Okay, now we'll move on to our learning objective 3, where we're going to be describing the accounting and reporting for stock compensation plans. These are very interesting, I think, from the standpoint of those of us that have had stock compensation plans. We always look forward to that. A stock option, an important definition here, gives key employees the option to purchase common stock at a given price over an extended period of time. The effective compensation programs are ones that base compensation on performance, help motivate our employees, help retain our key executives, as well as recruit new talent, maximize the employee's after-tax benefit, and use performance criteria over which the employee has control. So if we look at a little bit at the trends and magnitudes of CEO compensation, you can see here by this diagram that compensation for the company based on stock compensation is fairly significant for these major companies here. And millions and millions of dollars of stock compensation are being paid out. Okay, stock options from an employee's perspective. So is the company giving you stock? No, the company is giving you the option to purchase stock at a specific price. You're not obligated to use the options, but if you do, you must pay for the stock at the specified exercise price of $20 per share. Now, you probably are not going to do that unless the current value is more than $20 a share. And then when would you make sense for you to exercise those options? Once the 3-year service period is ended and you're vested. That means you have the option to use those options. The key factor in your decision is going to be the market price of the stock. So suppose the current market price is 30 bucks. Does it make sense for you to exercise your options? Certainly yes. You can purchase the stock for 20 bucks, sell it for 30 bucks, and realize a gain of $10 on that transaction. Alternatively, you can hold the stock and hope the market price continues to increase and sell at a later date for even more earnings. Now, suppose the current market price is $18. Does it make sense? No, you're not going to purchase the stock at less than your exercise price. You would lose money doing that. Are the options transferable? Generally not. You cannot sell or trade your options because they were granted to you as part of your unique compensation package. Do your options expire? Generally, yes. Options typically have an expiration date. If the market price of the stock never goes above the exercise price of the options, then you would not exercise them and they would expire and be worthless. All right, determining expense. Compensation expense is based on the fair value of the options expected to vest on the date they grant the options to employees, i.e., the grant date. So, how do we allocate that compensation expense? We recognize compensation expense in the period in which its employees perform the service, called the service period. So let's look at an example. On November 1, 2024, the stockholders of Dunder Mifflin Paper Company approve a plan that grants the company's 5 executives the options to purchase 2,000 shares each of the company's dollar par value common stock. The company grants the options on January 1, 2025. The executives may exercise the option any time within the next 10 years after a 2-year service or vesting period has elapsed. The option price per share is $60. The market price of the stock at the date of grant is $70 per share. So, under the fair value method, the company computes total compensation expense by applying the Black-Scholes option pricing model. The fair value option pricing model determines Dunder Mifflin's total compensation expense to be $220,000. You will not be asked in this course to do the arithmetic behind the Black-Scholes option pricing model. Okay, questions. How would you record A, alpha, the grant of the options, and bravo, the compensation expense in 2025 and 2026? Under alpha, when we grant the options on January 1, 2025, no entry is needed. The service period is 2 years. Therefore, the compensation expense is allocated evenly over the 2-year period. So, to record the compensation expense for the end of 2025, we're going to debit compensation expense for $110,000 and credit paid in capital for $110,000. And we get that number by dividing $220,000 given the model here, given in the problem here, by 2, half. Then in 2026, we record the same journal entry. So as indicated, compensation expense is allocated evenly over the 2-year service or vesting period. Now, if Dunder Mifflin's executives exercise 2,000 of the 10,000 options, you'll remember that's 5 employees getting 2,000 shares options each. So that would be 10,000 shares. So it's 20% of the options are going to be exercised on June 1, 2028, 3 years and 5 months after the date of grant. The company records the following journal entry. We're going to debit cash because we're for $60, and that'll be $120,000, and debit paid in capital stock options 20% of 220,000 or 44,000. Common stock then will take on the par value of 2,000 times $1 with the additional paid in capital in excess of par of 162,000. Okay, pretty straightforward there, I think. Now, if they fail to exercise the remaining stock options before their expiration date, the company transfers the balance in the paid in capital stock options account to a more properly titled paid in capital account, such as paid in capital expired stock options. Dunder Mifflin is going to record this transaction at the date of expiration as follows. So you'll remember that we've exercised 20%. So that leaves us with 80% of 220,000 or 176,000. We'll debit paid in capital from stock options and move that into paid in capital expired stock options for 176,000. Okay, so if we look at a summary of option accounting, here we have the grant date, the exercise date, and the expiration date. So this service or vesting period is where we're going to record the compensation expense, and we're going to allocate that over that vesting or service period. And then in the exercise period, if the market value is greater than the exercise price, the options will be exercised and the shares of stock will be issued. So the fair value options is determined at the grant date and used as compensation expense, and no journal entry is required. But if we have expired options that remain in equity as paid in capital, we'll move those into a separate account. Okay, major advantages. There are 2 types of restricted stock awards and restricted stock units. 1, determine the total compensation expense based on the fair value of the stock on the date it is granted. 2, recognize compensation in the periods in which the employees perform the service. And 3, make no adjustments to compensation expense due to changes in fair value after the grant date. Okay. This looks like a good place for us to stop this video, and when we return, we'll take a look at this illustration of a restricted stock award. Until that time, bye for now.